The debt bomb no one's talking about, until it explodes. The quiet danger beneath the boom. Every boom hides a shadow. While stock markets hit new highs and headlines celebrate soft landings, a dangerous illusion is quietly spreading across the global economy, the illusion that debt doesn't matter anymore. In the US, national debt has surpassed $35 trillion, growing by billions every single day. Japan's debt to GDP is well over 260%. Europe is juggling deficits, and in emerging markets, borrowing has reached record levels just to keep lights on and food on tables. Meanwhile, household credit card balances are at all-time highs. And corporations are rolling over old debt at higher interest just to survive. The world is drowning in IOUs, and barely anyone's talking about it. Why? Because debt has become politically convenient, economically addictive, and too big to question. Central banks once kept it in check. Now, they enable it. Governments once feared it. Now, they campaign on promises built with it. But here's the truth, debt isn't free. And when confidence cracks, the cost will be brutal. Throughout history, debt crises have never arrived with a loud warning. They build silently, like pressure inside a fault line, and explode when you least expect. From Argentina in 2001 to the 2008 global meltdown. From Greece's sovereign collapse to Sri Lanka's recent implosion, the pattern is chillingly familiar: denial, delay, then disaster. In this episode of Money Minded, we'll uncover the hidden architecture of this global debt bomb. We'll explore who's fueling the debt and why they can't stop. How central banks are trapped in a lose-lose game. What black swan event could trigger the next global crisis? And most importantly, how you can prepare before it's too late. Because once this bomb explodes, there's no pressing rewind. Stay tuned, this is the debt story no one's telling, until it's too late. Chapter 1. Debt to infinity, the new normal? We're living in a world where trillions no longer shock us. In 1980, US national debt stood at less than $1 trillion. Today, it's racing past $35 trillion. Adding over $1 trillion every 100 days, and that's just the federal level. Add in state, local, corporate, and household debt, and you're looking at a number that no one can truly comprehend. But America is just the beginning. Globally, total debt surpassed $315 trillion in 2024, according to the Institute of International Finance, over 3 times the size of global GDP. Advanced economies carry the bulk, but emerging markets are catching up fast, especially in Asia and Africa, where development increasingly relies on external borrowing. Even more disturbing? This surge isn't tied to productive investment. It's largely debt used to service more debt, cover budget deficits, or maintain lifestyles that real incomes can no longer support. A new era of fiscal illusions. Central banks and governments have normalized this debt binge by shifting the narrative. They say, debt doesn't matter if interest rates are low. We owe it to ourselves. We can always print more money. But these are illusions, convenient myths that ignore economic gravity. In reality, rising interest rates are pushing debt servicing costs to historic highs. The US now spends more on interest than on national defense. Sovereign credit ratings are being downgraded. Not just in struggling nations but in developed countries too. Debt to GDP ratios are becoming unanchored, particularly in nations with aging populations and low productivity growth. Japan is a cautionary tale. With a debt to GDP over 260%, its economy is caught in a slow-motion trap: ultra-low rates, low growth, deflationary pressure. And a central bank that owns a massive portion of the bond market. It's a zombie system, sustained only because the rest of the world hasn't rejected the yen yet. Now, that same playbook is being quietly adopted by others. The mirage of soft landing. Much of today's optimism hinges on the belief that central banks will engineer a soft landing. Inflation will cool, growth will return, and all will be well. But this dream ignores the underlying rot, debt that cannot be paid back without triggering default, devaluation, or inflation. The IMF estimates that 60% of low-income countries are already in debt distress or at high risk of it. In places like Ghana, Sri Lanka, and Zambia, reality has already struck. Currencies have collapsed, bondholders were wiped out, and basic government services fell apart. Yet, major economies are pretending they're immune. They're not. The difference between a debt crisis in a developing country and one in a G7 nation is not scale, it's confidence. Once that evaporates, even the biggest economies become vulnerable. No exit in sight. What's truly alarming is that there is no viable exit strategy. Politicians are incentivized to borrow, not to cut. Central banks are trapped, raise rates. And they trigger defaults. Lower them, and inflation comes roaring back. It's a corner with no good options. Even modern monetary theorists, once vocal about government's ability to borrow indefinitely, are going silent. The theory works in a vacuum, but in the real world, debt always has consequences. Eventually, a slow burn. Then a sudden shock. For now, the debt bomb hasn't exploded. Markets are calm. Yields are stabilizing. GDP growth is decent in some regions. But that's exactly how these stories go. As Hemingway wrote, how did you go bankrupt? Gradually, then suddenly. We're living through the gradually. The question is, when does suddenly arrive? And what will be the spark? In the next chapter, we'll follow the money trail from reckless governments to over-leveraged corporations to credit-strained consumers. Because everyone's borrowing. And no one's ready to pay it back. Chapter 2. From stimulus to survival, why everyone's hooked on debt. Debt used to be a tool. Now, it's a lifeline. Over the past 2 decades, borrowing has morphed from a strategy to fuel investment into a desperate means of survival for households, corporations, and entire governments. What began as short-term stimulus during crises has become a permanent addiction. Governments spending like there's no tomorrow. Let's start at the top. After the 2008 financial crisis, central banks slashed interest rates and governments rolled out stimulus packages to keep economies afloat. Then came COVID-19, and with it, a flood of emergency spending. Trillions were printed, borrowed, and distributed in a matter of months. And here's the problem, the emergency never really ended. Politicians quickly realized that debt-fueled spending wins elections. Who wants austerity when you can just borrow more? Universal basic income trials, student loan forgiveness, green energy subsidies, corporate bailouts, all increasingly paid for with borrowed money. Not tax revenue. In the US, deficits are now structural, not cyclical. Even in years of economic growth, the federal government spends far more than it collects. In Europe, nations once bound by strict fiscal rules, like Italy and France, have watched those limits quietly dissolve under political pressure. Debt is no longer the exception. It's the plan. Corporations. Zombies rising. It's not just governments, corporations are deeply entangled in the debt web. For over a decade, easy money allowed companies to borrow at virtually no cost. Rather than invest in productivity or innovation, many chose a quicker payoff, stock buybacks, executive bonuses, and M&A binges. Now, with rates rising, those loans are coming due, and many businesses can't afford to refinance at today's higher yields. The result? A wave of so-called zombie companies, firms that can only pay interest on their debt, not the principal. According to the Bank for International Settlements, over 20% of publicly listed firms in advanced economies now fall into this zombie category. These companies continue to operate, but they no longer generate economic value. They drag down innovation, productivity, and long-term growth, while inflating financial markets artificially. It's corporate life support, paid for with borrowed time and borrowed cash. Households borrowing to stay afloat. And then there are everyday people. In much of the developed world, wages have failed to keep pace with inflation. Yet, the cost of living, housing, education, healthcare keeps climbing. The result? More and more families are turning to credit to fill the gap. In the US, credit card debt surpassed $1.3 trillion in 2024, a historic high. Delinquencies are rising. Buy now pay later schemes are booming. And auto loans are stretching over 7 years just to make payments manageable. In countries like the UK, Canada, and South Korea, household debt-to-income ratios are nearing breaking points. The middle class is no longer living beyond its means, it's borrowing just to maintain its standard of living. This isn't consumer confidence. It's quiet desperation. The psychological trap. Here's what makes this crisis unique: it's not just economic, it's psychological. For years, central banks taught the world that cheap debt is normal, that borrowing is safe, that rates will always stay low. So now, as reality returns and interest costs climb, millions are facing a future they were never told to prepare for. Imagine an entire generation of businesses and consumers who've never known high interest rates, budget cuts, or credit scarcity. Now imagine what happens when that world ends. It's already starting. Mortgage defaults are ticking up. Personal bankruptcies are rising. In 2024, corporate defaults hit their highest level since the financial crisis, and the pace isn't slowing. The debt web connects us all. The scariest part? These debt burdens aren't isolated. They're interconnected. Governments depend on consumer spending, which is increasingly debt-driven. Corporations depend on low interest rates, which depend on stable inflation. Households depend on job stability, which depends on corporate solvency. One crack in this system, a market shock, a banking panic, a political failure, and the whole web can unravel. And when it does, the blame won't just fall on one sector. Everyone will suffer. In the next chapter, we'll explore the role of central banks and why the very institutions that once kept debt in check are now trapped in the system they helped build. Chapter 3. Central banks can't save us anymore. The guardians have become prisoners. For decades, central banks were seen as the ultimate safety net. When markets wobbled, they cut interest rates. When recessions hit, they printed money. When debt piled up, they bought the bonds. They were the adults in the room, calm, credible, and always ready with a monetary toolkit to restore order. But today, that toolkit is broken. And worse, central banks are trapped by the very system they built. The great policy flip. To understand how we got here, we have to go back to the aftermath of the 2008 financial crisis. The Fed, the European Central Bank, the Bank of Japan, all turned to quantitative easing, QE, to stimulate growth. They slashed interest rates to zero or below and pumped trillions into markets, inflating asset prices and suppressing borrowing costs. At first, it worked. Economies recovered, albeit slowly. But QE became a habit. Central banks forgot how to stop. By 2020, the pandemic forced another explosion of QE. Rates were pushed even lower, balance sheets ballooned. And trillions more were injected into the financial system. But there was a catch, and it was coming. Inflation, the monster returns. For over a decade, central bankers feared deflation. Now, they fear something far worse, sticky, structural inflation. From 2021 onward, prices surged. Supply chain shocks, energy crises, labor shortages, war in Europe, all contributed. But at its core, inflation was a symptom of too much money chasing too few goods, after years of ultra-loose monetary policy. So, the central banks were forced to act. The Fed hiked rates at the fastest pace since the 1980s. The ECB followed. Even the Bank of Japan, once the king of yield suppression, began hinting at tighter policy. But every rate hike came with a cost, debt servicing became more expensive, defaults began rising, and the financial system started showing cracks. No good options left. Here's the bind. Raise rates to control inflation, and you risk a debt spiral, recession, and financial instability. Cut rates to ease the burden, and you lose credibility, trigger currency devaluation, and reignite inflation. It's a lose-lose game. And central banks know it. The Bank of England, for example, had to reverse its rate tightening to buy long-term bonds and rescue UK pension funds in 2022. That moment exposed a harsh truth: monetary policy is no longer about discipline, it's about survival. They're not steering the ship anymore. They're patching leaks. The illusion of independence. One of the most dangerous myths in modern finance is that central banks are independent. In reality, they are now politically entangled and financially dependent. Their balance sheets are bloated with government bonds. Their actions move markets with a tweet or a whisper. They face enormous pressure from both politicians and the public to not crash the system. Take the U.S. Federal Reserve. It must now pay more in interest to banks and money funds than it earns on its own bond portfolio. For the first time in modern history, its running operating losses, a symbolic but serious signal of strain. In other words, the lender of last resort is broke. Confidence is cracking. The power of central banks has always rested on one fragile asset: trust. Trust that they can act independently. Trust that they can control inflation. Trust that they know what they're doing. But cracks are appearing. When the Fed says it will stay higher for longer, markets don't fully believe it. When the ECB talks about normalization, bond spreads in Italy and Greece widen instantly. When the Bank of Japan intervenes, speculators test the limits the next day. And in the global south, Argentina, Turkey, Nigeria, the story is even worse. People don't wait to lose trust in central banks. They assume collapse is coming and act accordingly, buying gold, dollars, crypto, anything but their own currency. Is that a preview of what's to come in the West? The clock is ticking. Central banks are no longer the solution. They are part of the problem. Their credibility is eroding. Their tools are blunt. Their options are limited. And the debt overhang they helped enable has now tied their hands. The next crisis may not be triggered by a housing collapse or a bank run. It may come from something far more dangerous: a loss of faith in the system itself. In the next chapter, we'll explore what that trigger could be, and why it might come faster than anyone expects. Chapter 4 of the trigger: what could set off the debt bomb? The fuse is lit. What lights the spark? Every debt crisis has a trigger. But the true cause is never the trigger, it's the accumulated pressure behind it. In 2008, it was Lehman Brothers. In Europe, it was Greece. In Asia, the Thai baht. None of these were the root problem, they were merely the match. Today, we live in a world soaked in financial fuel. The question is, what spark will ignite the next explosion? Let's explore the possibilities. 1. A sovereign default in a major economy. We tend to think of debt defaults as a problem for developing nations. But the line between stable and unstable is growing thinner. Take Italy, with debt over 140% of GDP and chronically low productivity. Or Japan, with the world's highest debt burden and an aging, shrinking population. Even the US, while far more resilient, now spends more on interest than on its entire military. If investors lose faith in just one major sovereign issuer, if a bond auction fails, or a political crisis sparks capital flight, we could see a chain reaction of rising yields, collapsing currencies, and forced austerity. Remember, financial markets don't punish slowly. They punish suddenly and brutally. 2. A currency crisis in a systemically important country. Emerging market currency crises are nothing new. What's new is how interconnected everything has become. If China, the world's second largest economy, saw a sharp yuan devaluation, it wouldn't stay local. It would ripple through global supply chains, commodity markets, and debt contracts written in dollars. Likewise, a collapse of the Japanese yen could destroy confidence in the Bank of Japan's decades-long stimulus strategy and force global investors to unwind trillions in carry trades, triggering a violent global liquidity crunch. Currency is no longer just money. It's a vote of confidence, and once it's lost, recovery is slow and painful. 3. A credit event in the shadow banking system. Much of today's debt doesn't sit on bank balance sheets. It sits in the shadows, in private equity funds, hedge funds, insurance firms, pension schemes, and non-bank lenders. These entities operate with far less regulation and often much higher leverage. In 2022, we saw a glimpse of this when UK pension funds nearly collapsed due to unexpected volatility in the bond market. The Bank of England had to intervene urgently to avoid catastrophe. Imagine that happening in a larger, more opaque market, like China's property sector or the US corporate debt market. A failure in shadow banking could spill over into the real economy instantly, with no bailout mechanism in place. 4. Geopolitical shock and energy price spikes. Energy is the heartbeat of the global economy. When oil or gas prices spike due to war, sanctions, or shipping disruptions, the knock-on effects are massive. Higher inflation, lower consumer demand, pressure on government budgets, increased borrowing to subsidize energy costs. We saw this with Russia's invasion of Ukraine. But imagine a conflict in the South China Sea, or a closure of the Strait of Hormuz. Energy prices could double overnight, and debt-laden governments would be forced to borrow even more just to prevent unrest. Geopolitical shocks don't cause debt bombs, but they can detonate them. 5. Loss of faith in central banks or fiat itself. The most dangerous trigger of all isn't a number. It's a feeling, panic. If a critical mass of investors, citizens, or institutions stop believing that governments and central banks can manage the debt, the illusion shatters. People rush to protect themselves into hard assets, foreign currencies, Bitcoin, gold. Bond market sell-off. Yields soar. And suddenly, refinancing $35 trillion at 2% becomes refinancing it at 6% or more, completely unsustainable. This isn't science fiction. It's happened before, in Weimar Germany, in Zimbabwe, in Venezuela, in Argentina. The difference is scale. This time, it could be global. The problem with soft crashes. Policymakers often talk about soft landings and orderly deleveraging. But history suggests otherwise. Debt doesn't unwind neatly. It builds slowly and then crashes spectacularly. The longer the reckoning is delayed, the more violent the outcome. Every delay adds more risk. Every stimulus kicks the can further. And every complacent investor becomes a future victim. In the final chapter, we'll explore what happens after the explosion and what you can do right now to protect yourself from the fallout. Because by the time the headlines arrive, it will already be too late. Conclusion: after the blast, a new financial world? What happens when the system resets? When the dust settles? Every financial crisis leaves two kinds of survivors. Those who were lucky and those who were prepared. The global debt bomb we've explored isn't just a looming threat, it's a mathematical inevitability. The numbers no longer add up. Debt is compounding faster than income, faster than growth, faster than any central bank or politician can keep up with. We're no longer asking if it will blow, but when, where, and how bad. So what comes after the blast? A hard reset of the financial order. History teaches us that debt crises don't end with gentle corrections. They end with resets, defaults, devaluations, currency changes, political upheavals, a new monetary architecture. After World War II, the world moved to Bretton Woods. After the 1970s inflation crisis, we saw the petrodollar rise. After 2008, central banks became the new rulers of markets. What will the post-debt bomb world look like? Possibly a move away from fiat dominance. Possibly the rise of commodity-backed currencies or digital financial infrastructure with strict fiscal discipline baked in. Or, perhaps, a multipolar world where nations hedge between BRICS, the dollar, and decentralized alternatives like Bitcoin. One thing's clear, the next system won't look like the one we've known since 1971. From complacency to resilience. Most people, institutions, and even governments are not prepared. Why? Because the current system rewards short-term thinking. Politicians borrow votes. Corporations chase next quarter earnings. Consumers live on buy now, pay later. Even central banks are playing catch-up. But history punishes complacency. This is the time to start thinking long-term again. If you're a saver, consider how exposed your wealth is to currency debasement. If you're an investor, evaluate whether you're holding assets with real value or inflated illusions. If you're a citizen, demand fiscal honesty and monetary integrity. The biggest opportunities are born from the biggest crises, but only for those who are paying attention before the headlines hit. This isn't doom, it's a wake-up call. At Money Minded, we don't believe in fear-mongering. We believe in financial awareness. Understanding the global debt trap isn't about predicting collapse. It's about recognizing fragility and positioning yourself wisely in a world that's changing faster than most realize. The system we're living in wasn't built to last forever. It was built for a different era, an era of growth, stability, and trust. That era is ending. The new one? It's being written now, by nations, by markets, and by individuals like you. Will you be a spectator? Or a participant? If you found this video insightful, don't forget to like, subscribe, and share it with others who need to hear this. We're building a global community here at Money Minded, and we're just getting started. Until next time, stay informed, stay aware, and stay financially independent.